When Warren Buffett was 10 years old, he used to go to Omaha's horse race track, which was called Oxerbahn. He used to go there when the race was over, and he used to pick up all the tickets thrown by the people, thinking that there must be someone who must have thrown the winning tickets. Because a lot of people used to come there to enjoy. They used to buy tickets, get drunk, and throw the tickets in the drunkenness. Warren Buffett used to collect thousands of tickets one by one and check whether there is a winning ticket or not. He used to get many such tickets every time. He knew that no one would give money for winning tickets to a 10-year-old kid. That's why he used to give the winning tickets to his aunt, and she used to take them to the counter and cash them. This habit of patience and reading remained with him forever. When he was 20 years old, he started his investing career under the name of Buffett Partnership. He used to read Moody's manual the whole day. For those who don't know what Moody's manual is, nowadays we have websites where the information of companies is organized and we can screen it as we wish in seconds. But when technology was not advanced, a book came which was called Moody's Manual. In this book, the basic financials of the company were given in very small letters on one page for 5-6 companies. Warren Buffett used to read it the whole day, and even today, Warren Buffett reads the annual reports of the company. He used to read it, and he believes that the biggest compounding knowledge is that which many people don't understand.
Read and read and read. I probably read 5 to 6 hours a day.
So, this was the first rule of investing. Learn a lot, read a lot. The second rule of investing is to know what you own. Peter Lynch tells in his book, Beating the Street, that the 7th class students of a school named St. Agnes had a portfolio of 14 companies whose 2-year return was 70%, whereas the Index Fund of America, S&P, had a return of 26%. I mean, they beat the index fund. Actually, all this started after a discussion between a class teacher and CEO John Morisi. Both of them wanted to prove a theory that no one needs an MBA driving license or skills in Excel to make good investments. And this theory was proved. So the question was, how did the students choose these stocks? What did their teachers teach them? The first thing that was taught to the students was never to invest in such companies, which you cannot explain with a single reason what the company does. And whenever the students chose a company, the first thing they were asked was to tell what the company makes. What products or services does it offer? If they were unable to tell this, then they could not invest. The next thing that was taught to the students was that if we are investing for the long term, we can get more opportunities for growth in small companies. Now, let's say Reliance's market capitalization is around 5 million rupees. So, if we buy Reliance's shares, then our money will be 10 times if this market cap also becomes 10 times, 5 million rupees to 50 million rupees. To achieve this, Reliance will have to launch new products or bring some major changes because in the markets where they already exist, they are already a major player. That's why it is difficult for our money to grow more. And this is the reason why many investors believe that small companies grow faster. In such a big market, new entrepreneurs are coming who start with a listing of 2,000, 4,000 million. And from there, they grow very fast, reaching 10, 2,000 rupees. Great investor Manish Babray has also mentioned this many times that if a big investor invests in a small company, then he won't get much benefit. If he can invest a maximum of 5 million rupees and the company grows 10 times, then his money will be only 50 million rupees, which is not very beneficial for him. That's why, as the investors grow, they leave very small companies and invest in big companies in which more money can be invested. Now, this means that small investors like us get opportunities to invest in these small companies.
The bottom continuously gets emptied out, right? So the people who were really good at finding the investments, less than 10,000 to put to work, less than 100,000 to put to work, if they're really good, they move up.
The next rule says, hold no more stocks than you can remain informed on. This concept says that a human can maximum follow only 8-15 companies and can remain informed about them. That's why it is better so that we don't take more than 10 stocks in our life. But those 10 stocks should be such that we feel that we have actually met the owner of that company. We have signed a 100-page agreement with him, and we have made a deal with him. and then we give him money and buy the shares of that company. In short, Warren Buffett also believes that if we get 3 super businesses which are doing very well, then an average person doesn't need more to do good in life.
But 3 wonderful businesses is more than you need in this life to do very well.
The next rule of investing says, if you like the product, chances are you will love the stock. Peter Lynch says that in my family, all 3 girls wore clothes of Gap. But despite being an investor, I never thought that I could invest in this company. And the price of this company was 13 times in a year. But next time, he was careful. He took all his 3 daughters to a mall, and they saw which product they wanted to buy. But this time, they didn't go to Gap's showroom. They went to a shop called Body Shop. There, Peter Lynch saw that there are many women who are buying lotions and creams from Body Shop, and the shop was packed with people. The next day, after reaching the office, Peter Lynch asked for annual reports of Body Shop. And after its fundamental analysis, he came to know that this company is opening its showrooms very aggressively in the world, and every showroom is profitable. So he recommended this stock to his management, and its price increased multiple times. In India, there is a similar case. If we talk about Royal Enfield's bikes, which are very famous in the name of bullets, then its stock price has increased from 1.22 rupees to 3,500 rupees. That means every 100,000 has been converted to 300 million. If we talk about Britannia Industries Limited, then this stock started from 58.23 rupees and has increased to 4,568 rupees. That means if we had invested money in this during IPO, then it would have increased to 100,000 rupees and become 45 million rupees. So in short, the message is that the products which we like, if they are publicly traded companies and if the company is financially stable, then we can use this method for screening. The next rule of investing is trying to time the market. Peter Lynch says that the experts, they don't know when the market is going to increase or decrease. But their job is to pretend that they know. That's why they give free advice about what is going to happen in the market next time. The main focus of the best investors is to buy good businesses whose products the public actually needs. Because if businesses are actually growing, then in the long run, its share price will also grow with the rate of actual business growth. That's why it's better to focus on businesses than to time the market. Timing involves everyone's time. Exactly. And the biggest challenge for an investor today is what is going to happen in the market, when to go in, and when to buy. In that, all the energy is wasted. I mean, 99% of the people are not in the market because they haven't been able to time it properly. The next rule says free cash flow is the king. This point says that earnings if the company's profit is only increasing, but its cash flow is not increasing, then there might be some problem in the company. For those of us who are not familiar, let's clear these terms in simple language. See, earnings mean profit. But what will happen to this profit also matters. Actually, when companies publish their financial reports, if someone has to give money to the company, that means the company has given the money on loan, and we still have to get that money. They would have included that in the profits, and this can confuse us in analyzing the company. That's why Warren Buffett's favorite indicator is free cash flow. To understand free cash flow, let's first understand cash flow. Cash flow is the money that is actually with the company. Let's say we talk about Reliance's cash flow statement. So, we can see here that Reliance had cash in March 2018 of 1,266,000 million rupees. In March 2019, it was 3,745 million rupees. But in March 2021, it was minus 13,523 million rupees. And if we see the earnings of Reliance in the profit and loss statement, then it is 49,128 million in positive. But the cash flow was minus 13,523 million rupees. If we want to know the whole story of what is happening with this, then we will get to know only after reading the annual reports of Reliance what money has been spent and which is yet to be spent, etc. And this cash flow is made up of 3 things. Cash from operating activities, A. The cash that came to Reliance from the main operation, which is the most important for us. The second cash can come to the company from investing, I. A. If they've invested in other companies, etc. And finally, the cash that can come to them from financing activities, I. A. If they have taken loans, etc. And the actual free cash flow, which we call KING, is the cash flow from the operation minus capital expenditure. IA. Let's say your business makes a profit of 1 crore rupees every year. But the nature of your business is such that you have to install a machine to run your business next year, which will cost 99,000 rupees. So what to do with such a profit of 1 crore rupees? Because you will have to spend 99 lakhs rupees on the machine, because of which the actual profit is 1,000 rupees, and this is called free cash flow. That's why we should always keep an eye on the company's free cash flow. So let's revise quickly. What are the 7 rules of investing that we have learned? Rule number 1 was learn a lot, read a lot I. A. The more you learn, the more you earn. We all know the compounding of money, but we think very little about the compounding of knowledge or investment. Rule number 2 was the second rule of investing, know what you own. In this, we saw the story of the 7th class students that if we can't even tell in very simple words what product the company is making and how it will increase its earnings in the future, then it is better to stay away from such businesses. Rule number 3 was over the long term. It's better to buy stock in small companies. A small company can grow more percentage-wise as compared to the already big companies. Now this is not always true, but in maximum cases, this has been seen. Rule number 4 was hold no more stocks than you can remain informed on it. A. Buy only those stocks whose stories we can keep an eye on. Warren Buffett says that if we get 3 good companies in our life, then only they can improve our life a lot. Rule number 5 was that if you like the product, chances are that you will like the stock. In short, if a lot of people are liking the product, then this is a good screen test. After this, we can research the company and find out more about it, and it is possible that we will get good companies as well. Rule number 6 was that trying to time the market A. When to enter or exit the market. It is better to find good businesses which can actually grow because in the long term, the growth of the share and the growth of the business will be almost the same. And finally, in rule number 7, we learned that free cash flow is the king. IA. Don't just trust the earnings, but free cash flow is a perfect indicator to tell about the company. And if the cash flow is negative, then it doesn't mean that the company is bad. To know the true reason for this, we have to read the annual reports of the company and listen to their earnings calls. Even good companies are not easily available, so we have to work hard. Thank you for watching, and we will see you in the next video.